Welcome to Perspectives with Wenchi Yu, where we analyze the policies and political strategies of Trump 2.0 and their implications for Asia, China, Taiwan, and beyond. Goldman Sachs' February 17th report expects Chinese stocks to rise by as much as 19% in the next few months because of DeepSeek's breakthrough and other AI adoption. The news about DeepSeek contributed to a 1.3 trillion stock rally in China just last month. Funds have been flowing into Chinese equities at the fastest pace in months, leading to expectations of more economic stimulus. But are these signs of a long-term recovery or just short-term fluctuations? China's equity markets have played a crucial role in the global financial system, often seen as both a potential growth engine and a source of volatility. So are China's equity markets investable? Beyond its current domestic economic challenges, the US-China trade war and ongoing geopolitical tensions have introduced additional uncertainty and volatility, making it less attractive for foreign investors. Today, we're speaking with Eric Wong, founder of Stillpoint Investments, a China-focused hedge fund. Eric has had a long and distinguished career in finance, starting with Morgan Stanley and later with Blue Ridge Capital. As a long-term observer of US-China relations, he brings unique insights. He's also a cellist who apparently manages stress by playing in an orchestra. Welcome, Eric. Thanks for joining us. Tell us, how did you get into finance?
Yeah, it was my first job out of college, and it was with an investment bank, Morgan Stanley in Hong Kong. I had done a lot of coursework during college on what was happening. I was at Harvard undergrad. I graduated in 2002. I studied economics, and a lot of the coursework was in what was happening in China's economy at the time. A lot of the restructuring of the state-owned enterprises, the very large ones, and then bringing them to the capital markets. So it was really cool just to see the textbooks come to life, and I got hooked. So that's how I got in.
Yeah, it was also a very exciting time. I think China had just joined WTO, and as you said, it was a lot of privatization of SOE, state-owned enterprises. So you were able to be a participant in that process. After Morgan Stanley, you joined a hedge fund, right?
Yes, I went back to business school at Harvard first, and then I joined a hedge fund called Blue Ridge Capital upon graduation, and they sent me to Beijing. So it was quite a life experience in a sense. I grew up in the United States, born in Birmingham, Alabama, grew up in Atlanta, Georgia, spent a lot of my childhood summers in Taipei, worked in Hong Kong after college with Morgan Stanley, but the opportunity to live in Beijing and to help Blue Ridge build out their investments in Asia and China more broadly was really an opportunity of a lifetime.
What year was that, and why? I assume that was during a time when, just a lot of funds and investors, foreign investors, that are starting to take part in Chinese markets, right?
Yeah, I mean, this was back in 2007. So at the height of the pre-Great Financial Crisis bubble, as it were. And at the time, China was clocking GDP growth double digits year on year and becoming the factory of the world. That was really the story of China at the time. And a lot of businesses were meaningfully benefiting from those large trends that were happening, as well as growing consumption domestically in China.
And then why did you start to think about having your own fund?
I lived in Beijing until 2014, and I moved back to the United States with Blue Ridge then. I started Stillpoint in 2020, and the mandate of Stillpoint is a little bit different from Blue Ridge in the sense that we are specifically focused on a single geographic market. So Blue Ridge was a global, large, multi-billion-dollar hedge fund. At Stillpoint, we are specifically focused on China. We have a smaller asset base and thereby are more nimble. We can do a lot of things that Blue Ridge couldn't do just because it was so large. And so it allows us to be able to be more nimble and take part in things that large funds have a harder time being able to put into their portfolio.
You started a fund solely focused on China because you have certain views about the market?
Yes, I think China has historically and continues to be one of the most dynamic markets in the world, right? I mean, Wenchi, you've spent a lot of time participating in Asia more broadly, so you understand. But from my perspective, as soon as I worked on those large SOE deals with Morgan Stanley, it was kind of like a calling in a way, in the sense of feeling and knowing that this is a once in a lifetime experience to be a part of such a large change.
What do you mean once in a lifetime kind of change? What did you expect to see the transition of China's economy?
When I first started to travel to China for work, and you looked around and you looked at what the young people were wearing, everybody was wearing the same tracksuit. There was a lot of, I think, underlying kind of individuality and expression, but it was finding outward expression in harder ways than one might have experienced in the United States at the same time. But if you fast forward to observing the young people in China today, you'll have a very hard time finding two people wearing the same jumpsuit, right? And so I think that's just one example of the large scale of change that's happening in China. And that's a very small sliver and a small, very mundane example of what I mean by that. But I think that level and that magnitude of change you're able to observe across many slices of the economy and many parts and facets of society. And so that's what I mean by kind of once in a lifetime opportunity to be alongside this change and find the opportunities therein.
Yeah, I wouldn't say it's mundane. It's actually extremely fascinating.
Is it? Okay. Right? Yeah, there's so much embedded in that, right?
Right. But and where else are you going to find that kind of changes with that kind of pace in one generation or two generations, right? I mean, that's why in some way, China is such a fascinating place, even just the economic space itself. And of course, in terms of society, as well as civic participation, political participation. I really want to focus on China's equity markets, since you're such an expert and have been doing this for so long. Just give us almost like a Chinese equity markets 101. What are the characteristics of Chinese equity markets? How are they different from the US, or how we understand a typical equity market?
In terms of what it comprises, it's a bunch of stocks, no different from the New York Stock Exchange, but the way that it's structurally set up is a little bit different and specific to China. When you think about the China equity space, there are a number of markets or bourses that comprise the Chinese equity landscape. So the largest chunk of that being the domestic equity markets. So these are called the A-share markets in onshore China. They comprise about, call it, $11 to $12 trillion of market cap. At the same time, you have the Hong Kong Stock Exchange, where you have roughly 4 to 5 trillion US dollars of market cap. Many of those companies are also Chinese companies that are operating in China and are listed in Hong Kong. And then beyond A-shares as well as Hong Kong, you also have a large swath of Chinese companies that are listed in the United States. We call them ADRs, American Depository Receipts, and they comprise about another $1 trillion of market cap. And so when we think about the Chinese equities landscape, it's segmented in ways that are unique to China. The investor bases across these different bourses are also different. And oftentimes the types of companies that you come across can look quite different as well. And so it is kind of a combination of these three markets that makes up the whole. Beyond that, I mean, I think there are certain specifics about each of these bourses that make them unique. I think probably the A-share market has the attributes that are most unlike what we recognize here in the United States, in the New York Stock Exchange, in the sense that the A-share market onshore in China has historically been closed off to the rest of the world. It was really only in the early 2000s that capital markets reform and enabled non-Chinese investors and institutional investors at that, licensed by the domestic regulators in China to be able to participate. And so this idea of being or needing to wall off China's A-share market from broader global economic fund flows was something that China felt it needed in order to enable and allow its domestic markets to become more mature, before being able to bring in more foreign fund flows. And over the course of the last 2 decades, you've actually seen the windows and the ways of being able to access the Chinese A-share markets from outside of China open up and become more numerous and dominant. So most important in that is the establishment of the Connect program in the Hong Kong Stock Exchange, which was done in the early 2010s. I think 2012 or 13 was when they first started to pilot it. But it basically enables investors that are outside of China to be able to access A-shares through the Hong Kong Stock Exchange without needing that license that I mentioned earlier that's granted by the domestic securities regulator.
So essentially, foreign investors can invest in HKEX, Hong Kong Stock Exchange, and through that invest indirectly or directly, it depends on how you look at it, into Chinese companies. Now, I remember that very well because, as you know, I was working at Goldman Sachs at that time. It was a big deal for the company. And so you might want to explain the logic behind this. Why is it that still people need to invest through Hong Kong? Why doesn't the Chinese government just say, we'll open doors to foreign investors and come directly to Shanghai or Shenzhen Stock Exchange?
I think that's ultimately what the regulators want to do, be able to open up the markets entirely. There are strategic reasons for wanting to phase that in the sense that the way that foreign capital behaves might be a little bit different from the way that the domestic regulators want.
What are they concerned about?
As an example, short selling is an example of that, right? So our ability to be able to short sell shares in the New York Stock Exchange or even the Hong Kong Stock Exchange is a lot more open than being able to do the exact same thing in the A-share market. And the licensing process that the CSRC, the regulator domestically, put forth in order for investors very early on to be able to participate. And then this gradual opening up through the Connect is, I believe in their minds, steps towards being able to make the domestic A-share landscape look much more similar to what Hong Kong looks like or what New York looks like or Tokyo looks like or London. But those are steps in the process to getting there. I do believe that that's ultimately their vision, but they do want to be able to do it in gradual steps.
And do you feel like over the last 10 years, especially given the US-China attention and just the growing distrust on both sides, is the capital market still continuing to be open, or there's a reverse trend?
It's interesting. I mean, I think the way I describe the regulatory progress in the opening up of China's capital markets to be like 3 steps forward, 2 steps back, right? And so if we
Let's go one step forward.
So if you look at the long-term trajectory of things, if we turn back the clock to when I started my career, it's much, much more open than it was back then, right? But I think if you want to draw a straight line, that would also be challenging because it zigzags. And I think the broader trajectory is one that has been consistent, and every now and then the policies seem to walk things a little bit backwards, and so it's trying to understand why that is and what's happening there. But I think the broader trajectory is one of them.
I think it's very telling just how cautious Beijing is when it comes to opening up its financial market and just waiting for various licenses. I remember when I was at Goldman, it was like waiting for years and years, and you never know when the license are going to be approved. which has been difficult, almost like a patience test for a lot of the
Yes.
foreign investors. So China's economy has changed quite a bit. So give us a quick lesson.
Yeah, I mean, it's hard to summarize what's happened in China's markets very briefly, but just looking at the comparative performance of the S&P and the Morgan Stanley MSCI China Index, for example, over the last 5 years, I think the S&P is up 80%. And if you look at the MSCI China Index, it's down 20% over the last 5 years. And so you have this really stark contrast between these two markets. And there are a lot of things that are causing the S&P to perform so well, but there are a number of reasons that are leading to this outcome. I think if you look at the structural challenges that the Chinese economy faces, a lot of people like to use the 3Ds. There's deflation, demographics, and debt. Then on top of that, and you mentioned this a little bit earlier, Wenchi, is the geopolitics of it. If we think about it, market participants and holders of A shares as a whole, 5 years ago, the percentage of overall A share holders that were foreign was probably in high single-digit range. This is specifically in the A share market. And today, these statistics are difficult to calculate precisely, but it's closer to those single digits, or at least half of what it used to be. Right? So those shifts have also created a challenging equity market environment for Chinese stocks. A combination of factors have led to the index being down over the last 5 years.
Let's talk about the structural challenges.
Sure.
As you mentioned, the 3Ds. Did you think the government see this coming maybe a decade ago? The demographics was kind of the problem in the making, right? Over the last.
Yeah, I would say that. I would say that demographics definitely. I mean, if you read through academic papers in China, you'll have seen people talking about the demographic challenge. At least 10 years ago, people were already up in arms about this, and I think the challenges have only become more pronounced over time. And then on the debt piece of it,
that was also a problem in the making.
Debt has also been written about, for more than a decade.
We've been hearing about it for like 15 years, probably more longer.
And so I think both of those first two Ds have had lead time in terms of being able to think about and absorb, at least conceptually, what those challenges could look like. I think the deflationary piece of it was something that was unexpected and has become more pronounced over the last, call it 12 to 18 months, 12 to 24 months.
China's deflation problem and also China's slow economic growth was unexpected and probably caught the world by surprise. If you remember, even before the COVID pandemic, there's some government crackdown on the tech sector, which clearly affected those companies' performances, but it wasn't the larger economic problem. And so what was the turning point? What was the inflection point from your point of view?
Yeah, I mean, if we think about the 3Ds and which one was more of a surprise, and we just established that deflation was probably more of a surprise than the other two. I remember first hearing about the possibility of deflation in China more recently in early 2023, right after China opened up after zero COVID. But I think when you say caught the world by surprise, I think you mean that the world had been expecting for China to rebound post-COVID in the way that we might have seen in the United States or other parts of the world with, revenge spending and revenge travel and all the things that people were doing after being staying at home for a very long time. You saw that for maybe 1 or 2 months, and then it kind of just whimpered out, right? And I think that's what you mean by caught the world by surprise. A few things were happening there. China did not give subsidies or checks to consumers to spend money in the wake of what was happening with the COVID zero lockdown.
Did they give out subsidies to small businesses as well? Because a lot of governments do
I
that?
think there were vouchers that were given out at the municipal level, but not at the overall national level. It was very limited compared to what was happening in the United States. The backdrop is quite important here, and you referred to that, Wenchi, as well, in terms of what had been happening prior to this reopening. And one was what we know now as the crackdown on the tech sector, what was happening with Alibaba at the time and the large platform companies, as well as online education. And then with property, right? There was a self-inflicted piercing of that property bubble that took place. Those things led to consumers being much more conservative about how they were spending money, especially when you consider the fact that they didn't receive cash handouts the way that consumers or folks in the United States did. That type of conservatism was very much also reflected in entrepreneurs who were planning their businesses going forward. This hesitance to put risk on in a way was being reflected across both consumers as well as entrepreneurs and business builders. And so I think that was what began to, I think, become or emerge more clearly in the springtime of 2023.
Yeah, I definitely notice a changing attitude from the Chinese people or foreigners or expats living in China during the zero COVID policy time. It was almost too extreme that people just felt that they couldn't take it anymore. Considering all these other policies Chinese government has implemented, however irrational or unreasonable they may be from our point of view, but this particular one seemed to really make people feel that I've had it. And so a lot of them with means and resources have moved out of the country, which we'll also talk about, but certainly has contributed to a level of pessimism and hopelessness almost about China's future. So given that, do you feel there's still opportunity in China?
Definitely. I mean, I think this is the way I think about it. I think, when an economy is growing, call it 8, 9, 10% a year, it's quite easy to be able to find businesses that are growing 30 to 40% a year. And you have this, call it growing pie, or a tide that's lifting all boats in a way. When that growth rate becomes single digits, 4, 5, 6%, it's a very different level of growth that the economy is going through. That said, the businesses that are being able to build and grow their businesses or their cash flow and their earnings at really, impressive growth rates are still there. I think they're a bit harder to find than before, but that's why you need to be able to, navigate the markets, understand what's happening to be able to find them. They're just not as abundant as before. What we do at Stillpoint is finding those opportunities that are there. But to think that because the economic growth has slowed in half, that there are no opportunities, that's also a very drastic approach in response to broadly what's happening. It's a different landscape and a different market from what it was 10 years ago. But the way that entrepreneurs are thinking about navigating this and building their way out of this can also be very impressive and exciting too at the same time.
Now, in terms of the participants in the equity markets, I think Chinese is unusual in the sense that they're mom and pop shops. There are just way more in the equity markets, unlike in the US, which tends to be institutional, right?
So and this is more specific to the A-share market again, which is the lion's share of market capitalization when we think about Chinese equities. In the A-share market, these numbers are rough numbers, but the percentage of the volume of trades that are retail trades, i.e. trades that are done by mom and pops, are comprise about 70% of total.
70%.
70. That number has moved around, but just these are rough numbers.
Still,
whereas in the US, it's flipped.
Like?
It's flipped, if not even more flipped, right? I think, the percentage of retail is way, way lower than the flip of 30 on 70, right? And so that creates, one, I think, that explains in a way why Chinese regulators want to be able to ensure some degree of stability in the domestic market, because the holders of these equities and the traders of these equities are mom and pops. Because 70% is retail, the way that stocks respond to news, or the way that the market might move in response to a new policy, can be very volatile, or sometimes completely surprise you. So those are attributes of the China A-share market that are specific to the A-share market. In the Hong Kong market, it's not necessarily the same.
And what about foreign investors? You have mentioned the percentage also has dropped to lower single digit.
This is something that has become more pronounced over the last 3 or 4 years, specifically in the A-share market has come down. And it's something that I think that the CSRC wants to be able to improve on. There is a drive to bring more foreign investors in, to make the landscape more amenable to foreign investors. But from a comparative perspective, a lot of foreign investors look at broadly what's happened in China over the last 3 years or 5 years and say, okay, well, this is what's happening in China. Growth rates are being cut in half. Why don't I go somewhere else that's more exciting or has greater opportunity? And the geopolitics of the world also looked a bit different.
What kind of policies are they creating to incentivizing? And also, I want to understand Hong Kong Exchange's role in all this.
On the whole, like if you were to ask a CSRC regulator, and this is hypothetical, they would like to be able to see greater foreign participation in the domestic markets. If I think about what their 20-year vision is, have a much more open capital markets relative to where they are today. There are elements that make it difficult, even if the policies make it friendlier for foreign investor participation, to ratchet up very rapidly. The thrust of your question was, is this what the government wants? I think the government would like more foreign investor participation, but this is where we are at this point. And I think they are trying to bring more foreign investors in. I mean, and this is another mundane example, right? The number of companies in the A-share market that foreign investors can access through Hong Kong, that list is being added to like every quarter. That's a signal of gradual opening up. Those types of things are steps in the direction of making it easier. The things that are making it more difficult for foreign investors to really increase that allocation to China, this comes down to the structural challenges that we talked about earlier, coupled with some of the geopolitics that we have come to know as very kind of constant.
Clearly, China has not been able to attract foreign capital is due to geopolitical concerns, as well as just the perception of China as a market. The risk level seems to be so high that, and there's also public relations issues for foreign capital investing in China. So China's economy is so massive that there's so many ways of looking at what's influencing the economy's performance. How much is geopolitics? I know it's hard to measure. How much is contributing to China's economic slowdown?
If you were to ask maybe a Chinese policymaker, they would attribute a lot of the slowdown to geopolitics and Trump's first trade war with China. It's a narrative that's easy to point to as the reason for the economic slowdown that China has seen over the last few years. But of course, it's very difficult to also not acknowledge the other challenges that China inherently has, regardless of the geopolitics of it all. That goes back to some of the structural issues that we spoke about. But I think from an investing perspective, it really depends on the industry and the companies that we're talking about here, right? I mean, there are certain industries that are very sensitive to geopolitics, and there are certain industries that seem to be completely immune from them.
Examples of both categories.
Sure. For example, if we were to, be talking about semiconductor equipment, as an example. That's like the thrust of, the purpose of a lot of the geopolitical tension that we've seen. But if we were to talk about milk tea
Beverage
being sold,
drinks, yes.
domestically in fifth-tier cities in China, and there's really not much, geopolitics at play.
And they're
there.
still doing very well, right?
It's very competitive, but they're doing
Yes.
well. It's something you have to pick your lanes and pick your battles. From our perspective, when we think about whether or not to engage in an industry or a stock, this consideration is oftentimes front
Critical.
and center for whether something we want to spend time on, or geopolitics is too big of a question mark here. Let's spend our
It's
time
also
on
out of
something
control.
that we can't analyze. Exactly.
Yeah.
So I think it really depends stock by stock or industry by industry. But certainly there are ones where geopolitics are a very big part of the story.
But overall, at least the Chinese narrative that it does affect Chinese economy. Clearly, the government has been trying to bolster consumers' confidence, investor confidence. And so we saw some stimulus moves last year, right? Twice, actually pretty big moves. And it seemed that well, I'm going to let you explain to people whether that's had any impact or not.
Since zero COVID, there have been a few instances of what seemed like the government in China getting ready to stimulate the economy in a meaningful way. One of those instances was probably July 2023. There was probably another one of these instances in July of 2024. Those episodes, the hopes were quickly dashed in the sense that government stimulus was slow to come, if at all. They were saying it's like being squeezed out of a toothpaste bottle. Like that's how slow a lot of the policies were being.
And it wasn't enough, right? People feel like they could have done more.
Yeah, it was always too little, too late, right? And so what we saw come out of China in late September 2024 was the government in surprisingly addressing a lot of the economic challenges that China has been facing just head on in a very explicit way. In a way, in my mind, was a moment of awakening. Maybe the government always knew that these challenges existed, but being able to talk about them head on in their own Politburo meeting notes was quite different from the way that these challenges were addressed in those previous cycles. What we saw come out of China in the fourth quarter last year was, at least in words, an intention to offset some of the challenges that China faces from an economic perspective on its own, those 3Ds that we talked about. And then, of course, that was happening right as the US elections were taking place as well, right? So there was an expectation or a connection drawn between wanting to stimulate the economy in the wake of what could be a very fast-changing geopolitical climate with the changes in the U.S. election.
In other words, whether Trump was going to return to the White House also had a huge impact. Yes.
Those couple of weeks right after the Politburo meeting notes that came out in late September, I was at least, and I think everyone else following China equities was sitting on the edge of their seat, seeing what exactly the government would roll out. If I were to just look at the index performance since then, you would say that the market has been disappointed by what the government has done thus far. It's not as I guess, dramatic of an episode as we've seen in other cycles. The stock market has been able to hold on to some of its gains prior to what we saw happen in late September. But just the trajectory of the index, you can see that the expectations have not yet been met yet. Still waiting to see what the government will actually put forth in terms of action. This, of course, as tariffs are being put onto not just China, but the rest of the world by the United States, throws another uncertainty into what the Chinese government can do.
So since late September,
Yep.
what concrete measures have gone to implement what the government wanted to see? And also, how has the market reacted?
A primary priority in what they were trying to roll out was the resolution of local government debt. And resolution is too strong of a word. Addressing local government debt. And what you've seen them do there is a debt swap. Basically, that doesn't take away the debt that these local governments face, but instead changes the interest rate that they're paying on it. So the debt servicing is not as severe on local government finances, which are already challenged because land sales are no longer as much a part of the revenue mix. At the same time, the policies also included some consumption subsidies that were meant to bolster consumer spending, which this, from many people's perspectives, is not yet unleashed, spending power that could help China transition out of the challenges that it faces now. The subsidies that came out were many of them were in the form of trade-in subsidies. So basically, trade in your old phone to get a new phone at a discount in order to spur consumption. And then for capital markets, there have been a number of policies to help stabilize or bring more fund flow into China's capital markets. And some of those policies include very strong directives to give dividends and to utilize the cash flow to return to shareholders. It was like a whole kind of basket of things that came in September and October. Nonetheless, people wanted to see and continue to want to see more. And so what you've seen is the broader index has come back down. And that's like a reflection of expectations not being met yet, and the emergence of more geopolitical tension as it relates to tariffs and how that could impact China's economic growth. If you look at GDP growth of 5% in China last year, 70% of that growth came from exports. Exports, huge engine of already hampered growth, right? If you're running that government, you don't want to have another kind of leg down. That's something that has caused the index to be challenged as well.
I mean, it's quite interesting to see a lot of people who don't really know that much about China oftentimes, would think that Beijing government somehow has this magic wand. They demand something happens. For the past few years, we've seen how much China is trying to revive its growth, even though everyone knows it's not going to go back to double digit or even 8. Reaching 5 would be fabulous news. However, it seems that the consumption remains low, and I've been hearing this like dual circulation. The Chinese government has been trying to have more domestic consumption, exactly for the reason that you just mentioned. So much of the economy depends on export. After Trump, I think they realize it's unreliable and it's too much of a risk to just rely on export oriented economy. So what are their alternatives? Why don't consumers spend money? And it's also not like, Chinese people all of a sudden become poor. It seems like they're still okay. It's just people are saving money. They're not spending money.
I think, lots of questions there. I think on the spending question, it's pretty easy to explain in my mind, at least. You look at the balance sheets of households in China prior to 2020. I would say that property comprised a very large portion of it. It depends on who you speak to. Some people had 5 apartments in Shanghai. It was not unusual to come across people that had more than one home for speculative purposes. And so when you have home prices having fallen precipitously over the last 3 years, people don't feel as wealthy as they
Mhm.
once did, that's a light way of saying if people bought at the peak and they took out a mortgage, maybe they're underwater on that too. So
Yeah.
that can be that can prohibit somebody from spending. And
Mhm.
another possible reason for people not spending is the unemployment that we've read about. The Chinese economy has struggled with, especially amongst youth
The young
over the last
people.
few years. Yeah,
Yes.
and so when economic prospects of being able to find a job are more challenged than before, they're also less likely to spend. So I think
Mhm.
from a number of perspectives, there are explanations for why that is the case.
Mhm.
We've spent a lot of time looking at this as well. Yes, people are spending much more conservatively, but they're also spending differently. From our view, it's not that people aren't spending at all. They are spending less, and they're choosing to spend their money differently. But it's interesting, during this period of time, the household savings have actually increased over the course of the last 3 years. So people actually have more money in the bank than before. And that goes to your point of maybe they don't feel poor per se, but I think whether that translates into consumer spend
Mhm.
is a different question.
Is China going to have another wave of growth? I've talked to some economists who say, oh, China's economy is going through this transition. It's a deliberate policy because the top leaders didn't believe the growth that China was going through was healthy for the people because they were concerned about the growing income gap and disparity. And so some of the emphasis has been placed on what they call the new quality productive force, which is China's version of manufacturing. The US also has been doing that over the last few years with a new industrial policy. How do you look at that part of the economy, more industrial hardware, like manufacturing based?
Yeah, I mean, I think these new productive forces is basically code word for getting all the things that China needs in order to be self-sufficient and well protected and well fed. When the idea of new productive forces was first talked about, I don't remember exactly when it was starting
2023.
to be. Yeah, it kind of conceptually was not a surprise. Well before that, we saw this Made in China 2025 program. Conceptually, it's going after the objectives are not too different. It fits into this broader concept of nationalism at play in China. And industrial policy is one aspect where you can see that nationalism at play. Just to be more specific about what these new productive forces are, it's basically programs to help China be able to produce the things that it is importing from other people today or doesn't have the ability to make today.
Dependent.
So that's a form of nationalism that's expressed through industrial policy. The spirit of nationalism is something that is also seen in within consumers as well. This goes back to consumer behavior and how things have changed. This goes back to that very mundane example around sportswear that we talked about earlier. But if you look at the market share of sportswear in China 20 years ago, it was like
Nike,
maybe two or three, four
Reebok,
brands, and then a whole bunch of
yeah.
other stuff, right? Like domestic stuff that maybe comprised very, very little of the overall market. And today, the market is very different in the sense that you have these large domestic brands that have actually now begun to go global. That is also a form of nationalism being expressed in a completely different sector. That's not really being driven by the government, but to me, it's like, in a way, two sides of the same coin. It's this idea of nationalism that is emerging across different sectors in China, and this new productive force, or whatever you want to call those efforts, are an industrial manufacturing based expression.
It's interesting you use nationalism to describe it. I was speaking to another guest, Benjamin Cho, about this, and in his own words, he thinks that it's in Chinese culture to be ultra competitive and always want to win. And so you can kind of see the trajectory. So in the opening days, of course, China is going to rely on a lot of foreign business goods like clothing. But at some point, they're going to want their own design. They're going to want their own goods. They're going to want their businesses. And so that's what we're seeing today. And even compared to pre-COVID, China surprised me just how domestic brands have really risen. And these are brands with very high quality products. And so the idea that China is mostly copycats or they only produce low quality goods seems no longer. It's reflected in their innovation and technology as well. That's why you have the DeepSeek moment. That's why you have the TikToks. You have, all these companies that are surprising the world. Would you say like that's an interesting phenomenon you're observing as well?
I think this rise of domestic Chinese brands, if we just go back to sportswear as an example, a lot of the brands in China that are domestically, back in the day, they were probably just outsourced manufacturers for the Nikes and the Adidases of the world, right?
So they're still manufactured by the same factories. They just have a different brand.
Yeah, I mean, you could argue that. I mean, I think that's where a lot of the know-how in terms of the manufacturing at scale was built. Eventually, over the course of time, these entrepreneurs thought, well, if I'm going to be making this for somebody else, I might as well be making it and putting my own brand name on it, right? And so I think there was a period of time when, Chinese brands, especially in the consumer space, were looked at as just copycats of the global brands, right? And you can probably point to even like brand names or logos that look suspiciously similar to the foreign corollaries at the time. Over the course of time, with especially the rise of e-commerce and live streaming and how products were sold or are sold in China, that made it difficult for large multinationals to adapt, enabled this period of very rapid ascension for the domestic brands because they knew exactly how these channels for distribution or sales were being utilized and how best to kind of squeeze the most value out of them. And so these are environmental attributes at the time that enabled them to compete fast, and then combined with that entrepreneurial spirit that we talked about earlier, that really drove the rise of domestic brands. And in today's China, where you have this idea of deflationary pressure or call it consumption downgrade, the domestic brands are now filling a space of being able to have an option as a consumer to have a product that's just as good for cheaper or even better but cheaper than the foreign brands.
For a long time, Chinese consumers are almost like the most reliable, dependable clients for a lot of the luxury brands and all the way down to middle class kind of brands. But these days, they're having a hard time.
And I would also think it's because these large multinationals that are headquartered somewhere else move slower than a young, nimble, hungry, and ambitious Chinese startup.
Totally. We also see them expanding overseas. So they're not just confined to their own domestic markets. And so tell us about the Chuhai phenomenon.
Yeah, I mean, Chuhai phenomenon has been going on for some time, but it really started to take shape in late 2023, post-COVID in 2023. With domestic growth not coming back, entrepreneurs started to think, okay, well, where can I get this growth? If it's not coming from China, then let me go elsewhere. And so this idea of Chuhai, which is going out into other markets, became a common strategy. We've seen this across a number of industries. You hear about it all the time with Temu, for example, PDD's Temu selling overseas. but you also, hear about it with EVs, especially being sold into, Europe, Southeast Asia, not yet in the United States, maybe not ever. But I think these businesses that are tapping the overseas markets are, in a way, emblematic of that spirit of entrepreneurship, basically saying, okay, if the growth rate domestically has, slowed to X from Y to X, and I still want to be able to generate this level of growth for my business, where else can I find it, right? And so going overseas, where you might face incumbents, competitors that don't have a product as good as yours, or that don't think about customer service in the same way, may actually be a competitive landscape that's good for an extremely competitive product or offering that has survived the extremely competitive landscape that is domestic China.
We see that across all sectors, steel, even, those bigger items that government has to get involved because they're just concerned about China's overcapacity, flooding their markets. And if they're less competitive, how could they protect their markets? So tariffs coming from Trump, but not only Trump, in terms of dealing with Chinese overcapacity seems to be happening worldwide. What does all that mean for China's economy? Let's just focus on US-China, because we do have a president that China is quite concerned about in terms of its tariffs policy.
I've heard different approaches to this. There are some people that say because it's round two, China is more prepared than ever.
Prepared meaning less dependent on exports to the US?
Less dependent on exports into the US, have a playbook that they want to be able to follow without having to make it up as they go. There were export controls that China put on for gallium and other kind of strategic minerals. I think that was a show of having done research to know where it might hurt more. And so that's I think that's an example of that school of thought where China has done its homework and is more prepared to deal with round two than round one. At the same time, I also think that the degree of uncertainty that looms over the trade relationship makes it quite difficult to be fully prepared for what happens. If you're thinking about how to retaliate to tariffs, if you're dealing with a range of 10 to 60, it's really difficult to have a good plan of action. Because the range of outcomes are so wide, right? And maybe that's a negotiation tactic of Donald Trump's, right? I think the Chinese regulators, from what I can tell, are taking the possibility of that very high end of the range very seriously. They certainly don't want to be caught by surprise, thinking that it's impossible and then actually having it happen. They're planning for the worst.
When you talk about Chinese equity markets, you have to talk about Hong Kong's markets because it plays such an instrumental role.
Hong Kong has historically played the role of being a window or a portal into China, right? And I think the stock market is very symbolic of that. Well before global investors could buy into the A-share market through a qualified foreign institutional investor license, you could buy, China Unicom or China Mobile or Bank of China in the Hong Kong Stock Exchange. The Hong Kong Stock Exchange is a bridge and continues to be a bridge, even for the Connect program that we talked about earlier. In order to access all these A-shares, it's being done through the Hong Kong Stock Connect program. Hong Kong does occupy this unique role, connecting and bridging China's domestic capital markets landscape.
Would you say Hong Kong's stock exchange performance is very tied to Chinese?
I think a lot of it is. There are certain businesses and clumps of the Hong Kong Stock Exchange that are less tied to the domestic Chinese economy. So as an example, some of these very large real estate conglomerates that are Hong Kong conglomerates that have Hong Kong specific assets. But beyond that, a lot of the stocks in the Hong Kong Stock Exchange are very closely tied to the underlying economic outcomes.
And why are we
trends
seeing
taking place
so many
onshore.
new IPOs now coming to Hong Kong, even just in the past few months?
It feels like a lot of new IPOs now, only because there haven't been any in 2023 and 2022.
So comparatively speaking,
yeah,
yes.
haven't been any is too drastic. I mean, there were a few
Very
select
few, yes.
IPOs, but there was a drought in Hong Kong and even onshore in the A-share market over the last couple of years. In the tail end of 2024, it started in probably spring or mid 2024. Was what felt like a flurry of IPOs compared to no activity the years before that. It still pales in comparison to the degree of and the scale of IPO activity that was taking place before COVID, but it nonetheless is a step in the more active direction. It signals a couple of things. One, some of these investors that wanted to exit weren't able to over the last 3 or 4 years when there weren't any IPOs, and so the fact that there are IPOs creates a window of liquidity for these pre-IPO investors that have been in those investments for so many years. But at the same time, the fact that the market can absorb and digest these new issuances signals a degree of activity and confidence level that the market didn't have to take on these IPOs.
Why should we participate in Chinese markets? In the US, there's been calling for complete decoupling. Since China presents such high risk, why don't we just divest from China completely?
One, just from an investment perspective, right? If we were to just compare the MSCI China index versus the S&P and where it's valued today relative to each other, just to give you a sense, the MSCI China index trades at 11 times PE, whereas S&P 500 trades at like 22 or 23 times PE. So it's twice as expensive or half as cheap, right? So there's a value element to it. The other piece of it is that the Chinese stocks as a whole are generating more free cash flow than they have in decades. This comes on the back of valuations coming down dramatically, but also spending being more closely scrutinized by Chinese entrepreneurs so that they're not just splashing cash everywhere. So the amount of cash that these businesses generate are a lot more than they historically have as a whole, just for the broader market and relative to the United States. So just to put quick numbers around it, the free cash flow yield of the S&P 500 is something like 2.5%, 2.7% or something like that. And China is closer to 8%. So again, from an investment perspective, you ask, why invest in China? I think it's cheap. The other perspective is that there's very, very low positioning. Foreign investor positioning is extremely low. Domestic investor positioning is also low. We talked about the savings, going up in the bank accounts. That money is not being tossed into the stock market in similar fashion. If it were to change, could be quite interesting as well. When you have an entrepreneur who is really driven to generate and squeeze growth out of a more challenging economic environment, when you couple that with the super cheap kind of valuation metrics, it's very compelling. You talked about some national security considerations as well. There are thousands of stocks in the Chinese stock market. And if you're looking to fill a portfolio, and like we do, of 20 or 30 stocks, avoiding the risk of what you described is not too difficult, right? Because we're just looking for a small handful amongst thousands that we think are worthy of spending time on.
Having more exposure to Chinese businesses, especially those that are really good these days, help us think about what the possibilities of good business can be. Again, going back to why is the world surprised by BYD's EVs or DeepSeek or TikTok or those companies? I think partially just because really don't understand how much Chinese companies have advanced in so many ways. And so do we want to continue to be surprised by those companies, or it's better to be prepared and know, okay, how else can we be more competitive?
It's in one sense important to be prepared to compete, right? But in another sense, it's also important to be able to learn from each other rather than ignore and disregard one another. I was listening to this other podcast last week where the founder of Uber, Travis Kalanick, and he was talking about food delivery. And he was saying that for food delivery, if you want to find out like the most advanced food delivery mechanisms,
go to China.
Systems, go to China, right? And so I think if you weren't an investor in Meituan or aware of what Meituan is doing, it might be harder to think about how to innovate and improve. This idea of competition is something that many businesses have survived under and survived through, right, in China. And so those, like the gems that they have unearthed, are worthy of at least understanding. That's what I find this idea of a complete disregard or complete ignoring of the Chinese equities as less practical of a solution.
Also today in Beijing on February 17th, Xi Jinping shared a forum with China's top entrepreneurs, including Alibaba's Jack Ma, Tencent's Pony Ma, Huawei's Ren Zhengfei, and founders and CEOs of other Chinese tech giants like BYD, Xiaomi, CATL, DeepSeek, and Unitree Robotics. Xi's last meeting with entrepreneurs was in 2018 when China's economy was vibrant. Today's forum was a clear message of Beijing's resolve to revive China's economy. But will it succeed? After the so-called tech crackdown, Jack Ma's appearance today was especially notable because since 2020, he was relegated from the symbol of Chinese entrepreneurship to a total retreat from the public eye. Some analysts think this meeting was yet another sign of government intervention and is too little, too late. However, it did become one of the most talked about topics on Chinese social media such as WeChat and Weibo. Will this enthusiasm translate into lasting optimism? Could it result in growing consumer confidence and stock market rallies, or will they be short-lived? For Xi Jinping, it's a gamble. This is Perspectives with Wenchi Yu, where we analyze the policies and political strategies of Trump 2.0 and their implications for Asia, China, Taiwan, and beyond. Thank you for joining us for the 4th episode of our series on Chinese technology companies and entrepreneurs. Previous discussions cover topics like the TikTok phenomenon, DeepSeek's role in the US-China AI competition, and an overview of China's tech entrepreneurs. We value your feedback. Please subscribe to our YouTube channel and podcast. See you next week.